please subscribe and don't forget to press the bell icon to get notified whenever we upload a new video.
Hi, good afternoon. You're watching Halftime Report. I'm Samira Abdi and with me is my colleague Nigel D'Souza. Hi, Nigel. Good afternoon to you, but not turning out to be a great afternoon actually to be an investor because we're just about trending flat now. I mean, we should pull up the intraday chart and look at it. As of now, just holding with the minor gains on the frontline indices. The Sensex just up about 30 odd points right now. But look at the mid-cap index. There, the fall is now about 0.4%. And even the banking stocks, they continue to remain a spot of bother.
That's right, Samara, and in the last 1 hour, odd pharma stocks, they have moved higher. So, that index should come up for you, and that's moved to the high point of the day. And also, you pull up the IT index. Both those two defensives, one would have thought they were clean bold, but in this year, both those two indices, in fact, they have bounced back. So, just keep an eye out on that front as well. We'll get chatting about that, and we'll also get you some highlights coming in from the United Spirits con call. Remember, that stock is a bit dizzy in today's trading session. The numbers didn't look too good, and the stock is down close to around 7.5% to around 8% the last time I checked. We'll try to get you some updates coming in from the con call. What we understand right now is that the con call is on, so we'll be waiting for some guidance coming in from the management. First up, though, running you through all the top headlines at this point of time. The market takes a breather after multiple days of hitting record highs. The frontline indices trade with minor gains. The mid-caps underperform, but United Spirits takes the biggest beating today after the Q3 shocking results.
IT stocks are the flavor of the day as frontline as well as mid-cap counters rally. TCS head honcho Rajesh Gopinath tells CNBC TV18 that the global environment is very positive and that IT spends are much more dynamic now.
And Bharti and Idea, they see cuts of close to around 5% as Relgio ups their game in the telecom tariff war by launching a 98 rupee plan offering free voice as well as unlimited data for 28 days. Idea also reports its third quarter results later today. An expectation is that they'll report a net loss of around 1,292 crore rupees.
In key earnings to watch, a CNBC TV18 poll expects Biocon to report a 40% drop in profits, while the street expects rural lender Mahindra Financial to post a strong financial third quarter. Canara Bank is expected to report a net loss for the first time since Q4 FY16.
And in CNBC TV18 Budget Corner, market experts say the impact of long-term capital gains tax is partly factored in and fiscal prudence is advised.
All right, let's get chatting about all the stocks which are buzzing in trade. It's time for movers and shakers, and United Spirits. That's the one we've been talking about, and that's the one that tops our list today as well, now down 7.5%. Sonal, take us through what has come through in the earnings.
Well, yes, the street is not happy with the kind of numbers United Spirits have come out. The stock is down in trade. Well, the numbers were not only lower than the estimates, even on a YOY basis, the numbers have come in lower. The revenue was down around 8% and the EBITDA came in down by around 7%. All of this leading to a profit decline of around 9%. Even removing the impact of one-time franchising agreement, the net sales were down around 2% and the volumes, they still remain a problem for prestige and above segment, which contributes to around 48% of the revenues. The volumes declined by around 3%, and this is the segment where we were expecting a growth of around 5%. Talking about the popular segment where they converted it into a franchisee segment, the volumes came in down lower by 22% and the expectation was only of a 12% decline. So that is definitely a dampener. In fact, the brokerages, they are also very bearish on the stock. Goldman Sachs has a neutral rating with the target price of 2,967 and Macquarie has a rating of underperform with a target price of 2,383 rupees, and street definitely didn't like the number.
Absolutely, the street has given its verdict. The stock is under some pressure, but the pharma stocks are doing well. And Ekta is with us. She's going to tell us about Syngene's numbers. Ekta.
Well, Syngene actually came out with what was not a bad set of numbers this quarter. So the revenue growth was over around 16-odd%. It has been one of the better revenue growths that they've shown in the past couple of quarters, especially post the fire that had impacted their sales. Their margins have been above 30-odd%, but it declined on a year-on-year basis. The management did say that there is a lot of capex which is coming on stream. So that was one of the reasons why you saw the kind of operational stress that they did. But nonetheless, they do expect the margins to be maintained anywhere between 31 to 33-odd% going forward as well. And hence you saw the profit up around 10-odd% this quarter. It seems as though the company is coming out of the fire incident that had taken place a couple of quarters ago, which had impacted numbers. And separately, they do have a tie-up with BMS or Bristol Myers Squibb, which is now scaling up, and hence that would be something to watch out for in the coming quarters. Remember that Biocon is also coming out with its numbers today, and Syngene would be a part of the numbers. It was expected to grow around 10 to 12-odd%, so over 15% growth is a positive when it comes to Biocon's numbers. Overall, Biocon's performance is expected to be flattish in terms of the top line, simply because of the small molecules business, which is around 35% of sales. The margins are also probably expected to decline on a year-on-year basis. What we will be watching out for will be the depreciation costs on account of the Malaysian facility getting commissioned, and obviously commentary when it comes to the biosimilar business, as well as the hiving off of the biosimilar business in terms of what they had announced last evening to a subsidiary.
All right, let's also head across to the United Spirits analyst underway. Let's hear out the management.
Which have happened more recently that I just shared with you. More extensive price increases during the year, continued focus on premiumization and accelerated productivity has led to 301 bips gross margin improvement, which stood at 47%, which we believe is really healthy and kind of in the zone that we want to be in. This, together with lower staff costs, has allowed us to increase marketing investments by 13% in the 9 months and led to an underlying EBITDA margin improvement of 73 bips to 13.2%. Interest costs were lower by 29%. This, coupled with lower exceptional items, has resulted in overall PAT increase of 28% over the 9 months. Looking ahead, while the adverse impact of the highway ban is behind us, we do expect to see continued impact of route to market changes in certain states, as I mentioned earlier, in this financial year. Importantly, we now expect that the adverse impact of GST will be more than offset by productivity savings and pricing. Finally, I do want to say this, that while we are not happy, and I know that many of you might have had some concerns with the soft top line, I really do believe that we have never been more confident about the current health and the future of this business. We have overcome some of the biggest headwinds that had the potential to not just derail this company, but to derail this industry, and we are past those. And we have come out much stronger for it. We are therefore committed to investing in the future, and some of the decisions that we've taken this quarter are in line with that perspective, so as to realize our medium-term ambition of double-digit growth and mid to high-teen margins. With that, I'm going to open up the lines for questions, which I and our CFO, Sanjeev Churiwala, will jointly address as best we can. Over to you, please.
Thank you very much. Ladies and gentlemen, we will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touch-tone phone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Participants are requested to limit their questions to 2 per participant.
Okay, we'll come back to this conference call as and when some of the questions actually begin. But as of now, the management over there saying that they're very, very confident about the future of the business. Amongst other things, they say that they expect a continued impact of changes in distribution channels on volumes in Q4 as well. But importantly, the adverse impact of the highway ban is behind them. I think they've begun the Q&A session, so let's go back.
would call it as a one-time impact of this franchise fee which comes in, which kind of comes into the base, because after that it grows at, if I remember correctly, a mid-single-digit number. So we're essentially trying to understand the drivers for further gross margin expansion. I understand the top-down premiumization part, but are there any bottom-up cost, efficiencies also which is feasible, once this one-off plays out?
Okay, so I'm going to request Sanjeev to address that now.
Yeah. Thanks, Manoj, for this beautiful question. I think many of you on the call would have similar questions on the shape of the P&L and especially how our gross margins are evolving. So let me tell you upfront, collectively as a management team, we have never been so confident in the past, as compared to where we are today. We are very, very happy the way our shape of the P&L, shape of the profitability and the future health of the P&L is emerging. I would like to just pause here and take you back on the shape of the P&L that we had a year back and how are things now in the 9 months' time. And this will give you some perspective as to, what kind of sustainable margins enhancement and profitability we should be looking at. In F16, if you have the numbers with you, you will see the gross profit stood at 41.5%. In the next 9 months now, our gross margins are 47.4%. So within in the 9 months, we have seen our gross profit margin enhancing overall by about 600 bips point. This is on the reported basis. So absolutely, there have been some impact because of franchisee, wherein the top line net sales has gone away, and to that extent, we see in place the franchisee income coming in. And we have very clearly called out that purely on account of the franchise that we see, we have about close to 160 bips impact because of the franchise. And that's the underlying performance that we're talking about. But when you look at our gross margins evolutions, I think it's perfect, right? We have seen a big productivity improvement coming in over the years, very clearly. GST impact, we said, is subdued, is more than offsetted by productivity as well as price increases. Our franchise business actually going as per our planning overall, right? If you look at the other shape of the P&L item, our overall staff cost, which was about 7%, remains almost flattish at 7%. A&P spend is as per aspirations of about close to 10%, right? And our other overheads is about 14.5, 15% all. So overall, as compared to a EBITDA margin of 9.4%, which we had for F16, we are standing currently for the 9 months at 12%, which is about 260 bips improvement in the EBITDA margin. I don't think a year back, we were always talking about this. There was always a question about our gross margin enhancement and our OP margin enhancement. So I think we are really delivering on ambitions on pricing, productivity, mix, and overhead improvement. We are now not a million miles away from overall aspirations of mid to high teen margin aspirations. We have really demonstrated in the last 9 months a very steady improvement in our gross profit margins and in our EBITDA margins. That should, Manoj, answer your discussions on the gross profit as well as overall margin mix.
Sure, yeah, and just to emphasize, our underlying gross margin improvement of 373 bips is without the franchise benefit, okay? Yeah. So that's underlying to the business. And the other thing I just want to add to what Sanjeev just said is, if you look at every line item of our P&L, right, it's moving in the right direction. It's in the direction in which the strategy of the company we wanted to drive. There has been a top-line impact this quarter, which we recognize. But if you look at every other line of the P&L, it's moving in the direction which we would like.
Understood. And that is very helpful, and all the best for this. Secondly, quickly on the input costs, allow me to say that there is a general consensus expectation that, input cost corrections, ENA price corrections, could potentially lead to, margin expansion. Of course, that's the job of the analyst to figure this out. But just from your perspective, how should I think about, help us in terms of, because historically, input costs would have been volatile in terms of inflation as well as deflation. Is this really an important source of funds for you to say that if input costs indeed get into a deflationary cycle, that does gives the liquor industry, the alcohol industry, a lot of sources of funds to reinvest?
Well, let me just say this first of all. So we have been in a relatively benign commodity environment. And when I say relatively benign, it has been less than general inflation, and it's been less than the inflation that we forecasted in our P&L for the year. And that has helped also drive the gross margins. Now, in this game, it is really hard to say what's going to happen because, if we could do that, we'd all make a lot of money together. But I think our view is that there will be some or could be some hardening of commodity prices as we look into the next fiscal. In fact, that's what we are expecting, that there will be some hardening, and we are trying to work around how to mitigate that to continue our journey of protecting and even building on our gross margin. So that's how we are approaching it.
Thank you. We will take the next question from the line of Arnav Mitra from Credit Suisse. Please go ahead.
Yeah, hi. Thanks for taking my question. The first question was on the growth itself. If you could help us give a sense that if these route-to-market change states like Haryana, Punjab, West Bengal, excluding this, what would be the range of growth that you would have seen in the rest of the country? And is it an acceleration over the growth that you saw in the second quarter? Why I ask that is this quarter had demonetization as a base, so there should be a low base effect, and gradually the highway ban effect should also be going away. So just wanted to get a color on the relative trends also between 2Q and 3Q on a YOY basis.
So there are many moving pieces, both in the numerator and in the denominator, right? Denominator, as you rightly said, there was demonetization in the base, and therefore it was a relatively softer base in terms of purchase and consumption. But equally, we pushed very hard during that quarter just to make sure that, we get the maximum that we can at a time when there was a lot of instability in the market. And when you look at the numerator this year, obviously there are these RTM changes that we are experiencing. If I looked at just underlying performance outside of the RTM states, we have built momentum over quarter two, right, in terms of our growth rates. And actually, I'm quite pleased with the levels of growth. I don't want to give a number there, but I tell you, we are pleased. We have built momentum, and we are pleased with the level of growth. So if this RTM changes had not happened, I think you would have seen a set of top-line numbers that have been far more in line with what you would have expected to see, right? The gap has been because of this, and we always knew that these changes are going to happen. And we as a company have played cautious during these RTM changes because recognize there is a lot of debt and therefore credit risk with these wholesalers. And in this industry, when RTM changes happen, parties disappear, huh? And then you can keep fighting them for as long as you want to recover your debt. But, then good luck to you for that. So we have taken the call, right? And that's ultimately a management call.
Right. Thanks for that. The other thing you had said is that you have made some provisions for the RTM changes. Could you just throw some light on what kind of provisions, and are they booked somewhere in the P&L?
So that provision would appear in the other overhead line, but if you really compare the overhead line as compared to the previous corresponding quarter, you will not see a major deviation because we've really been managing our overall overheads, far better than the inflation outlook, right? But yes, because of the prudent accounting policy, we did have to provide some provisions which is appearing in the other overheads.
Thank you. We will take the next.
We've been prudent, just to say this. We have been prudent on this, right? We could have taken the easier way out, but we have played prudent. And again, that's management philosophy and a management call.
Thank you. We will take the next question from the line of Avi Mehta from India Infoline. Please go ahead.
Hi, sir. Sir, just wanted to clarify this RTM change that you had mentioned about Haryana, Punjab, and West Bengal. Has Punjab also you have done a similar exercise, A? And B, would it be fair to assume that this impact of this RTM change should moderate from the current levels?
So absolutely it's going to moderate from the current levels, right? So Haryana was the most significant impact in this quarter. Punjab was an impact, but to a lesser extent, right? And the nature of this beast also is that we're waiting for formal government policy, and on things like this, policy also changes sometimes. So there is an impact that's in the quarter. Do I expect a big impact on Haryana in the next quarter? I expect a much lower impact of Haryana in the next quarter. All right, because we've taken a big impact in the quarter, right, and we've reduced sales. Now, Punjab may be a little more in the next quarter. UP could be a bit more, but UP is still a little blurred in terms of what is the government going to do? Is the monopoly wholesale system in UP going to change to a government corporation or a multiple wholesale model?
Well, United Spirits, a sharp recovery from the low point of the day. The management stating that, in fact, the impact that they saw for Haryana as well as in Punjab, that's not likely to replicate to the extent that it was seen in Q3. And that's why, in fact, the stock has recovered a goodish bit from the low point of the day. Also encouraging to see that the management is stating that, yes, the margins have improved. And going ahead, they are not far from looking at even mid-teen margins. And that's very, very encouraging as well. And that's replicated in the stock. And that explains why, in fact, we are seeing a bit of a recovery. Though they're saying that, yes, raw material costs have gone down, but they don't expect it to be so low. There could be some kind of increase there. So if you're trying to extrapolate that data point, then that's really not the way to look at it. And they're saying that, in fact, they've been very prudent with regard to the changes in the distribution channel as well. So just keep an eye out on that front. It's $100 from the low point of the day. By the way, we have IFCI. They're going to be considering a pref issue on Feb 5th. So keep an eye out on that stock as well. Remember, they've been talking about divesting some of their non-core assets as well. And now they're looking at a pref issue. So we'll keep an eye out on that stock. It's seeing a bit of an uptake as we speak. Then TTK Prestige, the numbers are flashing for you on the screen. I think there's a bit of a growth on the top line, but I think the margin performance has come in much, much better. In fact, there is a good expansion that we're seeing there. Remember, the management had guided to us that, in fact, the second half of the year will look better. And in fact, the blended margins for the year as well will look good. So 13% margins is what they've guided for FY18, the last time they joined us. And it's come in a tad bit better. Importantly, the management commentary as well, they're talking about, there was demonetization impact in the previous year. So that's why you can't really compare it. But domestic volume growth has been significant. And they're also saying that the key categories have grew in volumes between 12% to around 25%, except for cookware. So that's some commentary that's coming in there. They're saying that exports, though, that continues to lag. And I think the stock is more or less flattish, actually, as we speak. Some growth on the top line. Margin performance is quite good. And there is a bit of a jump in profitability as well. So we'll keep an eye out on that one. But moving on then, ahead of the upcoming budget, CNBC TV18 caught up with the top financial experts at the CNBC TV18 budget brainstorm. Here's a word coming in from Rhythm Desai of Morgan Stanley on his expectations from budget 2018.
We should not make a mistake of thinking that this is an idiosyncratic bull market. It's driven by SPX and by a host of other markets. Actually, the Nifty was a middling performer last year. So it wasn't like the top-notch market in the world. What was the top-performing index in the world last year was our small-cap index, up 65% in US dollar terms, the #1 performing market index in the whole world, followed by China. But the Nifty was around 35%, so it was in the middle of the pack. The economy, I think, is on a recovery path, so any acceleration in spending, so yeah, I think that's what the market will primarily look at. What is the government's expenditure growth for F19? From a market perspective, from the mid-90s, you look at the last 25 years, 23 years of data, the intraday volatility and the intraday volatility has been persistently declining. So there was a time when we used to get 6 to 8% move in the index through the day. That number has declined over years. So clearly the market has started pricing in stuff ahead of the budget, or you could say that the element of surprise in the budget has reduced. I think it's going to be a rural-focused budget, and that's no surprise to anybody. So rural infrastructure will dominate, I think, the finance minister's speech. So he'll be talking about, I think the big project will be last-mile electricity connectivity. So they've done exceedingly well by bringing electricity to the villages, but the homes have not received it. So you got talking about last-mile access. If they get 70,000-80,000 villages electrified in that fashion this year, it'll be a great achievement. That's one. Second is, I think there will be a big spend lift on rural roads. Maybe, micro irrigation. That could be a big thing in the budget. I think DBT, huge. There'll be a massive increase.